4, 3, 2, 1, and we are live. What's going on, everybody? Welcome back to Wolf. It's good to see you all here. I'm joined by Mr. Joseph from Milo. I'm joined by Mr. Robert, our master and macro expert, coming at you live as always from Wolf. Bitcoin sitting around $70,000, up like 2.5% in the day. Honestly, like the biggest story I've been seeing, obviously the Middle East, the war has been like kind of the top thing everyone's talking about. I guess the latest trend I've seen has been everyone pulling up the Bitcoin versus gold charts, talking about the outperformance since the war was kind of kicking off there. And I've seen really mixed opinions on that because, you know, for a while there, gold was outperforming, Bitcoin was taking a hit, and so everyone was like, you see like no store of value here. And everyone's like, like Bitcoin's back. And so I imagine it's probably too early on both fronts to tell. Like this is kind of wild times to be alive. I know Robert's been deep in those. He's been real deep in some of those spaces, whether it's on our panel or others. Anyways, there's a bunch of things going on in the macro world, in the Bitcoin world. So I'm excited to jump into it. If you guys haven't already, please do take a second, repost the stream as we get this show on the road. Joseph, I'd love to kind of kick it off with you, get some of your just general thoughts on the markets, kind of where we stand, or things you've been paying attention to, focusing a lot of your time on your side of the river. How's it going?
Yeah, things are great. Good to be here. Happy Tuesday. Yes, I see you're no longer at the $12 million pad. You're in the panic room. So
yes.
If you need us
cooked. Bitcoin's down, dude. Things are bad. I'm done for.
Gotta make some sacrifices, right?
Exactly.
Too much gold, not enough Bitcoin.
Oh no. It's funny.
Yeah, look, I mean, I think the world's in a really interesting place. I mean, I think this gyration of whatever is being said by the administration, and then whatever tweet or things are coming out, where you put on a position, and then all of a sudden, like a couple hours later, you're whipsawed the other way. Yeah. It after a few weeks, right? People get really tired of that. It becomes a lot harder, and then sometimes people are like, "Listen, I just got to be out of the market. I just can't. I can't do with this. I don't know what I'm doing here." And you make money and you get lucky, and then you lose money, and then like you don't know why you lost money. So I think that's probably the most frustrating thing for traders and for market participants. And we're probably approaching that time frame of people getting pretty exhausted. I think that from a couple streams a couple weeks ago, right? Like I was thinking that this would be fairly short-lived, and then now it's kind of like everybody's just kind of looking for an exit ramp of how to get out of it, how to save face, and it seems like that's going to be a really hard thing to pull off, primarily because of the egos involved. And you're probably starting to see some of the videos circulating on X of like how like actually enriching themselves at the expense of this war by charging to move through the strait and all these other things. So I think it's really wild that like everything that they thought could happen is actually worked out in an opposite way, and here we are probably in a worse position than we were 30 days ago with everything that's happened. So we're just in a really funky place. And I like the way Bitcoin's reacting here, right? Just sort of hanging in there, right? Kind of finding a really good support, good base, right? Down top of 60, we're kind of like hanging in here. Not a lot of reasons to be really long, not a lot of reasons to sell it. So I think we're sort of finding a really good support level. So that feels great. And then from the other sides, from us, business perspective, right? We're just trying to do more loans. We're seeing people getting more inquisitive. Primarily because we are getting a lot of reports of home prices in certain markets really start to come down. You're starting to see rents come down as well. So I think there's probably this base level thought that there's going to be some volatility in housing, and what that means is the people that are ready and are going to be able to pounce, and I think they're going to probably find some good deals out there. So I think we're feeling pretty good about that there will probably be this opportunity in the coming quarters, because I think that the damage of what has transpired over the last 3 weeks, it's unlikely that that's going to get that we're going to go back to where we were 30 days ago, right? It's going to be one of those situations where energy prices are going to remain high, infrastructure, right? Inflation is probably going to creep in. So we're going to have all of these sort of like downtrend effects that are going to play, and generally that's not going to be good for the consumer. So I think we are probably getting to the place, at least mentally, I'm thinking that we're probably going to have to start pricing in a recession at some stage, right, through the course of the year. And I think generally that's going to be fairly good for Bitcoin. I think things like real estate and other things that basically have felt pretty extended in terms of from a price perspective will probably come in just the way that we felt about gold. So I think you're going to have this where like some things are going to feel great and other things not so great. And I think it's just going to depend sort of like where you are within kind of the camp.
Yeah, that's well said. Robert, what are your thoughts, man? And I'll pull up your screen here as well as we get this show on the road. I'd love to get some of your thoughts. Anything Mr. Joseph said or things you're seeing in these markets too?
So I guess the move came in at 103 for today. So that's interesting. Yeah, I kind of agree, I think, with Joseph mainly on the main points. I do think that a recession is pretty much baked in at this point. You have to have a significant amount of demand destruction due to the amount of supply of oil being taken offline. And, you know, Strait of Hormuz, that's so average daily demand is like 100 million. It's actually like 105 million, but called 100 for easy math. So the Strait of Hormuz being effectively closed with traffic down 97%, according to Bloomberg yesterday. That's a 20% reduction in demand, right? Because you can't print oil. 20% reduction in demand is roughly equivalent with removing the U.S. economy from the global picture. It's huge. It's huge. And so to destroy that much demand due to the inelasticity of oil, that just means the price of oil has to go really, really high. And so, yeah, I think we're probably gonna this is probably going to continue. We're probably not gonna get an off ramp. I agree with like the what Joseph was saying, where it feels like everyone is kind of like trying to feel out an off ramp. But my read, at least, is kind of the three main parties involved with this particular conflict kind of all almost look at it through a sunken cost fallacy sort of way, where it's like, look, we've come this far, you know, whether it's Iran, which has been talking about, you know, America and Israel and stuff for my entire life.
Yep.
Israel's been talking about Iran my entire life. US, you know, certain people within the US have been cheering for, you know, trying to get war with Iran my entire life. So like, because you have these deep-seated kind of desires, I guess you could call it, I think that makes it difficult. Once you've kind of, you know, gone down that road, I feel like that, just my read, you know, that makes it difficult.
I mean, this really feels like this is our lifetime's Vietnam, right?
Yeah.
Where it's kind of like there is no winning, right? And you know, and I think you probably heard me say it in the beginning, which was like, okay, how do we know whether we've won? Like, what does winning look like? And here, like now, actually, winning looks like just stopping.
Yeah, stopping.
Yeah.
Literally.
Like of the parties where you say like Iran's got nothing to lose, Israel basically got the war wanted, and the U.S. is the one that's actually probably the least coupled to kind of to just say, you know what, didn't work out the way we wanted to. Let's just cut our losses and like be out of here, right? Like we didn't really paint, you know, China into the corner that we thought we could. Clearly, like the world is significantly more resilient and more intertwined than what we thought it was. We're not going to be able to just basically like have empty threats on the world. Like basically like the world's called our bluff to a certain extent. And it's probably better to leave. But again, I think unfortunately Trump, you know, has a pretty big ego. So I don't know if he will do that, but this would probably be that perfect place. And you kind of saw them teasing a little bit of that aspect of like, hey, like we won the war, we disabled this, we did that, right? Like trying to find a narrative to basically pull on that thread and try to like start to like sway public opinion. Didn't really work too well. So then now we're kind of like in this no man's land again, but it just feels like the part of the markets where it's like, if we actually do say here, like we're going to stop, like however it is, we end this or we pull back, I think markets are going to rally on that, right? Like equity markets, risk on, right? Like it's going to seem really good. But the oil and the energy destruction, like that's already kind of done,
baked
right?
in.
Like it's already a function of it where like there's no going back. And I think that was probably like why my original base thesis was like if this is over in like a week, then we're probably fine. Now we're past that. So now we're not. Now the question is like, where do we settle? And I think that is probably like the biggest thing to like, kind of like figure out. And like, you know, you're looking at like bonds, right? You're looking at the bond auction today, right? Like you're looking at sort of these things where it's like, hey, like markets aren't happy. So the question's like, are there certain things that like force the hand for us to have to like retreat from this because like the pain that actually starts to cause us actually ends up being the reason why like they lose the midterms, right? Like all of these things that are coming up where it's like here, like this is actually probably going to cause a lot of problems if we're here for like another 30 days.
Yeah, I mean, I think it'll be if there's I agree, and part of the reason I'm kind of like not optimistic is given who Trump is and his ego, to prevent him from being rational. That's part of the reason that I'm not haven't been so constructive recently, is because of who is kind of leading all this, and his motivations, his personality. It's not a statement from my one way or the other whether it's right. Just from a market perspective, like I see him as getting kind of in too deep, and he is so unwilling to admit defeat. He's got to find some kind of off ramp, like you saw, like Joseph was saying, a tease of this earlier with this gift. I haven't been able to look into it, but apparently he made a comment during the press conference about Iran giving some huge gift, and it was oil and gas related. So like
and then
maybe
coming back and saying, no, we didn't.
yeah, and it's just been constant. And like as I think if anything is going to force his hand, it's going to be the bond market. If you go back to Liberation Day, that's what did it. You had bond yields go vertical for a couple days there, and they capitulated. And that's kind of one of the consequences of having a NIP negative 92%
so today was probably like that first day of it, right? This was the first like tremor.
Yeah.
Right. Well, and like if this keeps moving, because again, there's so many bonds that continue to get rolled over, right? Like if something happens like next week, right? Like we actually do get a filled bond auction, right? Like something that now like, okay, this is bad, right? Like this is a real thing. And you're starting to see the headlines around the deficit, right? And sort of the imbalances where like, hey, it's 38 trillion, it's 39 trillion here. Now we're going to start asking for things, right? Like these are things that the bond market does really pay attention to, right? And that can really push it. I think that like one of the kind of questions I have around it, sort of like, or at least how things could potentially transpire, is we say, okay, well, we do find that off ramp. Where does that leave Israel? Like, do they, like when like the whole Gaza situation was, it's like they were like, look, we don't care, we're gonna keep going no matter what. Like we're in it, we're in it till as far as we can go. Does that mean that like they keep throwing missiles and rockets, and you saw what they're doing in like Lebanon and like the other side? So like do they just keep going? So like we pull out, but then the war keeps happening, right? And then now the question is like, okay, well, we're unlikely to work a truce between all three parties. So we leave, but they keep going. Is it worse that we now leave because now like you can be sure that like now probably like Israel's unhinged and they're just going to be like we don't care, like we'll blow up everything. They have like
50 to 100 nuclear weapons that we don't really know that
Absolutely.
They're not supposed to have.
I think they are a real they have a real position of power in the region where like they could actually just be like, what, the way we end this is like we show a really strong show of force. Basically the way that like the US did like, a big bomb. And like then how does the world feel after that? Because I think that then really tilts this in a place where it's like, okay, now Israel, like you really get everyone on your back because you did that. So that's my bigger fear, right? Is that if we it prompts that, and then now the world is actually even far worse than us being involved.
That's my exact fear as well, which is that even if America does find an off ramp, which I think again is unlikely with Trump and his ego and all that, right? Like even if we are able to find an off ramp, then okay, from my read, with what Israel's doing in Lebanon, I think that Israel's kind of looking at this as like, okay, here's our chance for greater Israel, right? They're going up to the Litani River, just according to what they've been saying, right, for years. So like they're
who's going to stop us? Who's going to rein us in? Like
no one. So if we step back, like you mentioned, then it just becomes, I don't think Israel would stop. If we step back, I don't think Israel would stop, which means that now you have a threatened Israel in addition to kind of the potential unhinged kind of, fanatical stuff going on. It could which as an American is so upsetting to me, because I don't want to see American men and women die anymore. You know, I don't want to see any more American treasure spent on this. But to your point, we could very well be in a situation where if America pulls back now, it gets even worse.
Yeah.
And so, like, how do you try to, like, you know, how do you have a read on the bond market? Or, you know, it's been really challenging to try to I do think that with the amount of oil disrupted, whether it be the 8 million barrels per day shut in, that'll take months to bring back online, whether it be the refinery in Texas, the refinery in Russia, right? It's not just the Middle East.
Yeah.
Even the Russian refinery, I think about 500,000 barrels per day. Texas refinery, about 500,000 barrels per day. You have the offset from the SPR, but that only lasts like 2.5 months. And it's only 2 million barrels per day. Like, you go through that math, and I think that the recession part of it is pretty much baked in my opinion. But you know, to the point about Bitcoin and how Bitcoin kind of fits into this, I think that benefits Bitcoin. Now, you know, it could get absolutely hammered in the short run, but to Joseph's point, it's kind of already been hammered. So maybe it doesn't actually sell off all that much going into a recession. You know, I could see that view. This is part of why I'm not short Bitcoin. I didn't sell my Bitcoin. I'm fairly confident.
Which is why we're finding the support here, right? Because there's no reason to basically buy it, but there's no reason to sell it either, right?
Yeah, it looks good.
It's just kind of hanging in here. The point I just made around just sort of like, what does like an escalation look like? And right now, it feels like, just like Bitcoin, this sort of war is kind of like, it's at an impasse, right? Like, it's neither moving forward nor backwards. It's just there. It's happening, but meanwhile, like, infrastructure is continuing to get destroyed.
Yeah.
So it's kind of like chipping away. So if we pull back, Israel feels that they can kind of get more aggressive. Iran's basically saying, look, there's really not a lot we have to do here. Like, we just have to like
attrition. Yeah.
You just got to, I mean, we're not going anywhere, right? Iran's a big country. Like, it's going to be around at the end of this. We're not sending troops, right? Like, tactically, there isn't anything other than destroying the infrastructure that can actually threaten them to actually win a war. And again, and we haven't really said that, like, what are our demands? Like, we want a new government, we want something, right? Like, that hasn't really been said in terms of sort of like, what is the change that we're pushing for so far? But in Israel, increasing the show of force, I don't think that's priced in the market at all.
No. Very little escalation is priced into the market, and I'm debating heavily, like, get buying a lot of SPY puts, because
oh boy,
yeah, I mean, just look at the chart. The chart looks awful in my opinion. You know, as a trader,
I mean, you could retrace right back to where that kind of like that peak is from the beginning sell-off. Right, we could retrace it really quickly, and in that situation, again, I don't think Bitcoin stays at these levels. I think it's very hard to imagine that it doesn't sell off even further, primarily just because of the ease of being able to sell Bitcoin, right? The liquidity factor of it relative to other things. And if you look at, you know, private credit and some of these other aspects that are out there, right? I think people are trying to shore up liquidity. And today in this world, I think people are trying to figure out, like, where is their liquidity? And in a lot of places, valuations are stretched in the public markets. So that becomes a little bit of a challenge, right? I was looking at Arbor, which is a lender in the sort of like commercial multifamily sort of space, earlier this morning, and they traded down from, you know, what was, you know, historically kind of like a 7-8% yield, and now they're yielding like 15% as a public company with their dividend yield, but primarily because everybody's so concerned that the delinquencies in multifamily. You know, that feels interesting, right, as a play, because again, it's probably still going to be fine, but like something like that will probably continue to get killed even further. And, you know, so you're going to probably find some of these sectors which just completely get obliterated from public headlines. And there'll
be a lot of value.
Really interesting buys where, like, if you see that thing get to like, hey, like 20% yields, like, yeah, they're going to recover. Like, multifamily is going to recover in this country, right? Like, there's no way, right? Like, we need housing. So but it could sell off pretty aggressively. And, those are the trades where like I've made some, in my career where like you bought things at levels that were so destroyed that just keep paying you these absorbent amounts of yield. And as things and the dividend yield continues to wind up enough that like you get equity like returns with like, debt like, instruments and fixed income mindsets where you get like 10, 12, 15, 20% IRRs and like pretty stable things. But it's because you bought them
when super distressed when it was like blood in the street. Yeah.
And the only thing you regret is that you didn't buy more of them. Right.
Yeah. Yeah. I mean, credit spreads are still like not indicating really much concern about anything.
No, because again, like anything credit related has been underwritten to pretty high standards, right? It's there's plenty of equity in there. Generally, when like equity happens, like the people who get burned are basically LPs and people who put in kind of like the risk capital. So this is a really good indication, right? That overall, people don't think that there's that much credit risk. Now, again, credit changes if you do have an escalation of war, right? If you do have these other aspects, where like that recession actually ends up being significantly worse, where like we didn't realize that like so much of what we consume is based off of petroleum products.
Yeah.
Now all of a sudden like
tripled in price.
Yeah, they didn't want to increase prices. Now they're like, hey, remember we got a war, like we now got to jack up prices by like 50-60%, or you can't have it, right? And people still need it, and we just can't produce it because we can't get the raw materials that we need to be able to do that. And then now all of a sudden you do get that, right? And I think that the Fed was pretty much like they were spot on saying like we don't know how to, we don't really know how bad this is potentially going to be,
or private credit and the AI story that no one is talking about anymore because it's so last month, but this is Blackstone and IGV. Some of these private credit funds have a huge allocation to software, and so like that theme or storyline is still there as well. And so I don't know, I find it hard to believe that we're gonna have a recession without it being significant, and therefore the intervention from they will print the money. It's just a question of now I agree that for now they are just kind of wait and see. I mean, if anything, in my opinion, I've been very critical of them for cutting over the past year, but if anything, I think now they should be cutting aggressively, which is kind of ironic for me because I've been so critical of them cutting before. But now you have an oil price.
Yeah, I think the only one of the main reasons why they don't want to cut is because they need that slack. Where like if we actually do get into a place where it's really bad, like they need to be able to like cut 50 basis points, 75 basis points in one shot.
Yeah, in a couple shots.
They're going to need that, right? Because that they need to find a way of injecting confidence back into the market in a situation where where it might be dissipating really, really quickly. If we do get that like worst case scenario, which is an escalation of the war, right? And to a nuclear extent, right?
Would you agree that so 1 year right now, 15 bips above Fed funds, so basically like a half chance of a rate hike over the next 1 year? That to me seems insane. Yeah. Is there value there at the front end? I don't see them hiking. I mean,
no, I don't think there's a world where they hike. I mean, I think that given again, it's all a function of just like how much destruction has happened and how much inflation could happen because of this destruction. Right. And I think that as time goes on and the longer we last in this situation and the more damage is done, the greater likelihood is that we will get inflation. We're going to get, good
for like a month or two.
Depends, right? It just depends how elevated, again, the things that we are bombing and things that are being destroyed, they don't come back online in 30 days.
Yeah.
They're going to come back in 5 years.
And the demand the consumption needs to be destroyed.
Correct. And it's unlikely to be destroyed in a situation where you have rates at these levels because you still have plenty of equity out there, right? You still have home equity, you still have consumers, you still have jobs, you still have all that. So, generally like people are not going to stop buying the things, even if things go up 50%. They're still going to need them, right? So like, like we would have to have a really, really, really bad, basically recession into depression.
Yeah.
For people to stop consuming.
But you can't print oil. So,
which is why, you know, those goods are gonna become hard to get, or they're gonna be more expensive, and that's going to basically push inflation, right? So from that perspective of saying, yeah, like we now have this like weird dynamic where like we wanted rates to go down, we want to jumpstart the economy, but we're going to have inflation.
I mean, to destroy,
right? It almost feels like where we were 3 years ago, right? We're like, we have inflation, we know it's high, we know it's coming down, but we want the economy to grow, and then like we've got this like weird like inflationary effects happening.
I mean, the only like parallel I can draw to what a world where consumption is falling by as much as the math I'm doing, which is right now running at about a 15 million barrel per day disruption, according to my math. 15 million barrel per day disruption or reduction in consumption, oil consumption. That looks, you know, that you're 75% of the way to Q2 of 2020. And GDP went negative 31%, you know.
We talked about this in our stream the other day, right, Robert? Or yesterday.
So the GDP report, I'm not sure if it's sharing, but yeah, for Q2, I'm reading it right here.
Yep.
This was the second read on Q2 2020. GDP, I wasn't doing what I do now back then. I can't even imagine pulling this up and like, oh, let's do a video on how the U.S. economy evaporated, a third of it gone, 31% in the second quarter. That's what consumption falling by 23 million barrels per day looks like. Well, if we're talking a 15, with an escalation, we could very well get back to 18 million barrel disruption very quickly. Iran just has to hit one pipeline, and you take that 15 million barrel per day reduction to 18 million. Well, 18 million, that's basically, you look around, it's going to look like what COVID looked like.
Yeah.
It's just
physics. Yeah, I mean, unless you get an erosion of sort of consumer confidence, which right now, again, the fact that there are several oceans in between us and Iran, it's unlikely to be felt here significantly. Now, the longer this goes on, the technology and things with AI are progressing at such an accelerated clip that if you were to ask me if we're still dealing with this like 3 months from now, 6 months from now, in some form or fashion, that is going to give every US company an excuse to lay off a bunch of people.
Yep.
Oh yeah.
Because everybody needs a narrative. And everybody knows that AI is going to increase productivity, and it means you're going to have to get rid of a bunch of people. But you can't do that if things are good. But you can't do that if there's a war. You can't do that.
100% agree.
Wow.
So we have created the perfect storm to allow corporate CEOs and boards to say, you know what, I think we can cut 35%. And then people are going to be like, well, tell me why we're not cutting 45%.
Yep.
Jeez.
And that could cause that consumer confidence to be shaken up. So these are all things that could potentially happen down the road. Now the question, do they happen? But so much of it is because of this initial fuse with this war, right? It's giving people an excuse to do the things that they wanted to do, but really couldn't do yet.
And here's even another one. If you're in Europe, if you're in France, for example, and the price of Brent is going up in dollar terms, everyone's talking about that. Everyone knows about that. But the part that makes it worse is the dollar is strengthening. Well, your energy bill is going up even more than the Brent price would indicate, right? Because the euro is weakening, and that is what your world is denominated, and you can't print dollars. In fact, you're structurally short dollars because of Eurodollar system. So not only is oil moving higher, but the dollar is moving higher. And, we can look to 2022, for example, when the last time we got, a huge run up in the price of energy, it pushed France into a significant current account deficit of about 63 billion. I think this is euros. Yeah, 63 billion euros. And we know, you can look at the tick data and see that Europe was dumping U.S. Treasuries. Okay, so what does that mean? So higher rates. Well, higher rates attract more capital globally, right? So the dollar strengthens even more, which makes the energy bill even more of a burden for Europe, for Asia. So they sell even more dollar assets like U.S. Treasuries. So there's the rate feed through, but then there's also the equity feed through. To Joseph's point about consumer confidence, which is that we know they own a lot of equity as well. They start dumping U.S. equities. Well, what is the American economy? 2/3 of it is consumer spending. Okay, well, of that 2/3 of the economy that is consumer spending, half of it is done by the top 10% of income earners. Well, that top 10% of income earners own 92% of household equity exposure. So the stock market starts to go down, and you have the wealth effect go in reverse. You just took out half of the 2/3 of the American economy just because the stock market went down. And that's not even the read through stock-based compensation and all the other the leverage associated, whether it be
Yeah, and again, and I think these are things that probably this would be sort of like the sequencing of these things happening. But we actually have an accelerant, which is AI.
Yeah.
And we don't know how that's going to be, right? Like if we said we didn't have a war, we had that, like, I remember 6 weeks ago, like we were all, talking about AI and, Claudebot and, and Moltbook and all these things. And like, we were kind of like glued to X on a weekend, because like I sent that to like everybody I knew, and I was like, you guys don't understand, like the world fundamentally changed. Like we're in a whole new world, whole new paradigm. It's not a question of if, it's just a matter of when.
That whole theme did not disappear, right? That is still there.
Like it got shut. It got, people are like, here, that went away. It's like, no, it didn't go away. Like things are accelerating at a massive clip, and the things that basically like Anthropic continues to release, every single week, is really, it makes my head spin every couple of days, because I'm like, wow, like I thought this wasn't going to happen for another like 6 months, and like here we are. And then like another week goes by, and then you're like, wow, we already did that. And then like the next week goes by, and you're like, wow, like it's one more thing. And so 6 months from now, I don't know, we're going to be in entirely different places, and every company, like I don't even think companies and boards can actually plan further than like 6 months out right now.
Well, and that's a whole other kind of thread to pull on, which is if you look at the $18 trillion of pledged investment that Trump always talks about, a lot of that came from the GCC, because they make a ton of money through exports. But if those exports dry up, because I don't know, their refineries are getting hit and there's a regional war and the Strait of Hormuz is closed, so too does the credit, right? They didn't actually invest the 18 trillion that Trump talks about. They didn't actually make any real concrete investments. They were pledges. Well, those pledges are going to evaporate very, very quickly. It's just accounting, right? If the current account surplus is being reduced, by definition, that means the amount of outbound credit is also being reduced. Well, what was all that investment in? It was in the one sector of the U.S. economy that's propping everything up, AI, data centers, right? So like that's a whole other thread to pull on. But like the more that I try to think all this stuff through,
and you can actually take those things and say, okay, like, do we need more energy? Yes. Okay, you can actually, with like big scale, long form projects that take multi years, right, to sort of launch, like you can actually, that's probably the only place where you could say, yeah, probably like if I make this investment, I'm probably safe, is energy infrastructure. But it takes a long time. Everything else, you don't know if you want to actually like make those investments anymore.
Yeah. I mean, I think that no matter which thread you pull here, whether it be the existing kind of underlying AI theme that we were talking about before the war, that's very deflationary. Whether it be the war and the disruption, the supply shock from oil, I think that's very deflationary. I'm looking through like the initial read through, which is, yeah, sure, there will be higher inflation. I'm looking to the big move, which I think is not the little pop in inflation that we'll get for a couple months, but the collapse especially if this conflict drags on,
Yeah.
the amount of demand or consumption, economic activity that's going to be destroyed, we are going back to ZERP, in my opinion. And so, like,
Yeah.
I'm kind of looking through the initial, you have break evens up a bit, and rates are obviously moving higher. Like, I think I'm kind of looking through that because I think the bigger move is what comes after that. And it's just physics, because you cannot print oil. So, whether it be 15 million barrels per day or 18 million barrels per day, that is a huge reduction in the amount of economic activity. And by the way, on the point about current account, South Korea is already kind of walking back some of the investment they had pledged. Because they're getting hammered right now. The price of oil is up. They rely on oil imports and refined products imports. They're getting squeezed, and so they're already
don't
walking
invest
back.
when you feel it, right? Like you try to
Yeah.
shore yourself up. You get more conservative, right? Like you worry about your own, and then you kind of say, here, let's settle out, and then you go back and say, okay, can we make the investment? And for a lot of people, it's kind of like giving them an off ramp to say, yeah, we're not gonna do this right now. We'll come back to it.
Wow. Look at the South Korean 2-year yield, which is vertical.
Wow.
Yeah.
Yeah. So going back to Friday, February 27th, it's up 62 bips. I guess that's, I mean, the move in bonds that we're seeing in other parts of the world is pretty wild to me. Like in the UK, they're indicating like 3 rate hikes last I checked, or I guess maybe like 2.5 now. But their economy was already on the brink, arguably, right? Like they were already in stagflation. UK, they had inflation at like 3.5 and growth at like 50 bips. Right. And then you're talking about rate hikes into that.
This is why the world is looking for liquidity, right? I mean, like,
yeah.
I mean, I haven't heard what Gunlock has said recently, but I'd be very interested to catch up on his commentary, because he has a really good perspective of everything that's happening in rates. And he was kind of talking about how like stressed the bond market was with some element of duration 6 months ago. So now he's probably more on the camp of saying, okay, like we actually do know like how this movie plays out. We just don't know the level of severity around it, which given all the things we just said, it's natural for people to be wanting to raise cash, right?
Yeah.
Get liquidity.
I am.
Be in a situation where if these things happen, then you've got plenty of dry powder, right, to allocate to these markets that, there's a lot of reasons for them to potentially become dislocated and overstretch on the downside. So you're going to want to have cash. And, the risk since 2013 has been, if you sold things when markets sold off, they recovered and then they went higher and they left you behind. So I think people are willing to maybe, lose some of the upside to be able to like live and fight another day with all of this uncertainty that's happening. Which is why I still continue to say, I think given this, I think Bitcoin's hanging in there pretty well. Because that's probably the one thing that people would probably be selling more of to shore up cash.
You would think, yeah.
You would imagine so, right? And even equity markets, right? I think that you would think the equity markets would have sold off harder, right? Given what could potentially transpire. So
I think they're going to.
I was going to say, do you think there's something holding them up right now or propping them up, Robert?
Well, I mean, no, I think the thing propping it up is a misplaced optimism or hope for physics to not be physics, and that this will all just kind of be rewound. I think that the market is slowly, number one, the kind of jawboning attempts I think are working less. And what really scares, or should, if you're along the equity market, what should really scare you is when market participants stop believing at all, right?
Absolutely.
That's when things get really ugly. And I think we're kind of getting closer to that point where
they
they just
always just said like, here, like the markets are, the government's going to prop up. We're going to have ZERP. We're going to get all these things, right? Like, yeah, but like we may get those things, but at a point, if those things happen, it might actually be worse.
Yeah.
It might actually trigger things that are far worse 10 years from now. So it's kind of like, be careful what you wish for where if you have enough room, yeah, like you can do ZERP, you can do all these things because it's not going to have that big of an impact. But when like, I think like it's too big, it's gotten way too big, right? We're at
Yeah.
38, right? Like, you know, a third of our spending is interest expense, right? Like the numbers are just gargantuan, right?
Bananas. Yeah. 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 I don't know. I think that, you know, there's nothing more bullish for Bitcoin than a recession. Now, it just depends, right, on when you bought Bitcoin. Because if you bought Bitcoin at 120, like, are we able to get back to 120? You know, say this kind of plays out in the sequence that we think, but, you know, initial kind of deflationary shock, raise a, you know, a liquidity squeeze, right? Everyone's trying to raise cash. Risk assets not doing too well. Maybe Bitcoin goes to, I don't know, 50 or 40 or 30 or something, right? Maybe even lower. But then the recession will act as a margin call on the U.S. government, right?
Yes.
Because in a recession, the deficit goes up by 700 to 800 basis points as a share of GDP. So you're talking about a 15% of GDP fiscal deficit in just like a baseline recession. That's just like vanilla run of the mill. If this is more severe, which again, I believe it very well could be, you're talking about like, you know, an 18% deficit maybe, or a 19%. There is no way the Fed does not come in and print even more money than they did in 2020. And oh, by the way, in a recession, you know, like we talked about, private credit will be
going to be accommodative to that type of positioning, right?
Well, and it won't just be the fiscal deficit. It'll be private credit. It'll be the mortgage market. There will be other issues. And so the amount of money, you know, it's that bullwhip effect where like the wave the amplitude of the wave gets bigger, you know, as time goes on.
Yeah.
I think that, you know, like if you have, you know, if you have 20, 30% cash and you're able to buy, you know, 20K Bitcoin, whatever it ends up being before the intervention, I think it's setting up some really, really like historic generational buy opportunities.
Oh, yeah. Absolutely.
And not just Bitcoin either. Like you were mentioning areas in the credit space that, you know, I'm sure there will be amazing opportunities, you know, all over real estate. You know, I'm hoping, praying, please give me a housing crash so I can buy a house, you know, like, but there will be equity. There will be, you know, in the real estate market, there will be all sorts of opportunities. Stuff. Yeah, for sure. So that's why I don't like
this place, because of the coiling effect, right? Because it's like this aspect where it's like, you know, heads I win, tails you lose mindset that the markets have had for, you know, almost, you know, coming out of the financial crisis, right? It's that like everything's going to save. It doesn't matter what happens. We're going to save you. We're going to save you. We're going to save you. And then I think that that's kind of like why equity markets are at these levels, because it's like, that belief that like there could be like one tweet, hey, like war's over, and then all of a sudden like everything's great again, party again, right? But we may get to that point where like maybe we go too far. And you know, my gut is there will be a point where we go too far, probably in our lifetimes.
And what do you think that looks like?
Just broader economy?
Yeah.
With the combination of AI and everything that's happening, I think it could be really painful. I mean, it could take us back to something of like how people felt in 2009, where people are very concerned. We're like, you just don't know where to go, right?
Yeah. And where do you put your money?
Yeah. And you know, I think, and those are the times where you're just like, okay, well, like everything is bad, but like what will survive?
Yeah.
And those are the best investments. I mean, like there's people that just did so well. So again, I'm not scared of that. I'm not concerned with that. I think that those are just like natural things that happen in markets where historically, right? Like you just had 7-year cycles where like, you know, you had booms and then you had busts. You had booms and you had busts, but like those busts is what allowed the pressure to be released.
Yeah.
But you don't allow that. All that happens is it just more pressure. More pressure. And then eventually it gets to the point where like it has to like explode and you just don't know where that's going to be. And I think right now we're like, it's private credit. No, it's housing. No, it's this. Maybe it'll just be everything because we propped up everything, right? Everything basically went up. I mean, like the fact of like saying here, like gold, like, hey, like equity markets were up, but gold was up. That means the world is concerned, but things are up. And like, we're coming down. It's like, how can everything win?
Yeah. I describe it as we tried to defy financial gravity
Yes.
for too long.
Yes.
Yeah.
Yes.
Yeah.
Yeah. Yeah.
I like the
now-
coiled spring. I like how you said that. That was a good visual.
Yeah, and like and maybe in the things that we're talking about, like maybe none of this happens. Maybe
Yeah.
it's some other event.
Oh, okay.
Because we thought COVID would be that event, right? We thought
Right.
in 2016, we thought there would be an event, and it didn't happen, and it didn't happen, and it didn't happen. And it's kind of like boy who cries wolf with
Wow.
markets, where like you're like just eventually you're just like, I don't think it's gonna happen. I you know, we're
Hey,
gonna
Robert's gonna have a heart attack if we duck another one. We'll be
Yeah.
like
Yeah.
a year and be like, dude, okay, what needs to happen here exactly for us to
I
see
finally get bearish after 4 years of being bullish on the economy and bullish on
dude.
the
Yeah.
stock market.
it's
Yeah.
been really hard. It hasn't paid to be a bear.
this? No, it
Yeah.
hasn't.
I mean, I got criticized by people, or people got the wrong idea, like that I was somehow enthusiastic about, oh, the economy is definitely working for every, American, and GDP actually means something for the average American. Like, I wasn't saying any of that kind of stuff. If anything, I was saying the opposite, right? Like, I get where they were coming from with the criticism of the bulls, but anyone that was just looking at the data could tell you that, like, it's just but we finally have a moment. We finally have a moment where there can be a cleanse, just like the forest can only regrow, right? When there's a fire every couple years. Like, I think it's a good thing. And someone called me a doomer earlier today. And it's like, I could not be more optimistic. This is what was needed. Like, we needed some kind of margin call on all the malinvestment. And we also needed a margin call, in my opinion, on globalism, right? And on the kind of interconnected, hyper financialized sort of economy that we had constructed. We needed to be reminded, no, energy is important. Now, the US arguably didn't need to be as reminded as, say, Europe, but I think it's, good reminder that, hey, the physical world matters. You cannot print oil. You can't print tungsten. You can't print silver. I think that in a number of ways,
Right.
not just kind of margin call in the financial sense for the government's finances, but margin call on kind of thematic things that for decades kind of neoliberalism kind of eroded. I think it's healthy.
And I think it could have gone on, right? Globalization could have gone on in a safe way, but everyone that sits at the table has to collectively agree this is a game we're playing. And the moment someone says, no, I don't like this game anymore, which is effectively what happened,
Yeah.
it starts to break down. And the one that had the biggest impact, which is the US, is the one that basically said, you know what, we're not going to play this game anymore. We're going to do tariffs. We're going to try to, level this out in our favor. And it starts to unwind, right? Because, naturally, like, things can be bad, but if we all say they're good, then they're good, right? We all agree they're good, even though they might be bad. But you just can't have a divergence of narratives, and that's essentially what we have had right now for a period of time. And I think the things that we're talking about here, they seem extreme, but I think maybe the reason why I'm saying them is more to enlighten and kind of say these are things that could happen. There are reasons why people should always be mindful to say cash is a position.
Yep.
And when things get really expensive, or you're looking at it and you're like, these valuations aren't justified, when companies that were just created yesterday and you're saying, they should be having multi-billion-dollar valuations, that doesn't make any sense.
Cade, what was I saying for the past year of our live streams? Right? You would ask about stocks or real estate or, right? We go down the list.
Yep.
And I would just say, man, like, nothing looks attractive here.
Yeah.
That was the world. That was my world from basically early 2025 up until recently,
And, that's
and so I built cash.
As someone who invests, right? It's really hard because you're like, am I crazy or is the world crazy? Someone's crazy.
And it went on and on. Like, I thought, Liberation Day. I thought Liberation Day was like, oh, okay, here we go. We're going to come back to Earth. But then, nope, it just kept going and going. Nope. So by October, November, December 2025, I was watching the repo market have major issues, watching liquidity drying up, right? And SOFR spreads blowing out and that kind of thing. I was
Yeah.
watching all that, but S&P 500 just,
Dude,
and-
nobody wants to be the one who makes it happen. Like
Yeah.
it's all,
Yeah,
there's
and
no
I-
incentive. It feels like for the guy who's going to make it happen.
Yeah,
I
and
just-
the thing is also is that, like, you look at the deficit and you look at the numbers and you look at what's been printed globally, and you say, okay, well, like there's 30, 40 trillion dollars that were thrown into the global economy over the last 15 years. That money went somewhere, and in
Yeah.
certain places, it got a multiplier effect.
Yep.
So it's natural that asset prices are worth more because of that printing effect that went into global markets. Now, it doesn't go away. It will slosh
well,
into the global economy.
we could
Now-
destroy. I mean, we could have actual deflation.
Yeah, we could. I mean, that's the concern, right? Is that like you actually can destroy those dollars that were printed into the economy, right? Like they can actually have destructive effects, but it doesn't mean that all sectors will feel it equally, right? There are some that will be significantly more volatile to those effects, potentially because of where they've run, but potentially because of that multiplier effect, right? If you look at things like equities, where if you say, okay, well, like why does a company trade at, historically, 7 times PE? Well, if it's trading at 50 or 100 times today, is that rational? Well, if that E gets cut in half, guess what?
Yep.
Like, valuation crashes almost instantly. And then in other sectors like real estate and other economies, which again, they're probably more resilient, but then the underlying credit that's behind them, if it has leverage behind it, could equally feel those effects. So I think that like that aspect of like price discovery is the one that the absence of these boom and bust cycles has become really difficult to ascertain what the fair value is of a lot of these assets. We've just assumed because all this money came in, fair value is higher.
Yeah.
And that's not true, right? Like that, we know that not to be true, at least historically. But for a long time, because of all of it, we just assume that, yeah, things are going to be worth more and the government can just print more and they can throw more capital. But it's not being thrown equally, right? It's being thrown in certain sectors, which is AI coming out of COVID, right? People got, $5,000 checks directly to the consumer to try to buoy them. And then we got consumer inflation across certain goods because of where the capital went. Now, I would say it's very much top heavy to big companies and, manufacturing companies. But I don't think mainstream America is feeling any of this capital coming in to help or save them. And arguably that's what ZIRP might actually do, which again might create inflation, right? On the other side of that, if we actually have that, right? And some of the discussions of like what happens when people potentially lose their jobs to AI and companies don't want to hire them for those skills. Like what is the implication of that? And that may not really come out to play for another 3 years, right? 4 years down the road where we really feel the brunt of that. But I think that's going to be the fascinating aspect, is that we're probably going to use the same things that we've done in the past, but they may not have the same effects. We may just print money, but without it actually like moving the needle, because it's very hard to inflate assets that we've all collectively decided are overpriced already.
Yep.
Yeah. Wow.
And the other thing driving, in my opinion, valuations higher that is very underappreciated is the old, I think it's the old system of running these huge current account deficits, right? Because what this means kind of just on an accounting basis is that if we're running a $1.2 trillion per year current account deficit, $1.2 trillion is pouring into U.S. financial assets every single year. That's a lot of money. And, that's broken up, between equities, real estate, U.S. treasuries, but there's still a pretty large, when you run a large trade deficit, there is a pretty large embedded structural bid into financial assets that, you start talking about a world where tariffs and deglobalization and much more balanced trade, much smaller trade deficits, you also remove a huge kind of structural bid in things like the equity market. And so, for turning, now I understand, as it's kind of playing out, now I'm starting to understand why people like Neil Howe and also Peter Turchin never gets appreciated nearly as much as Neil Howe, but Peter Turchin is great. I have his book right here. Peter Turchin, highly recommend. If people like that kind of structural demographic theory stuff, I would highly recommend Peter Turchin. Some of the stuff, it's almost unbelievable, but he lays it out. It's just data. It's going to be a wild, rocky road, I think, for the next like 10 years. This is kind of the one thing I predicted for the year was increased volatility, like in every possible way, whether it be financial market volatility, whether it be social volatility. Like, I think we went from kind of a short vol a period of time, multi-decade period of time, to much more of like a long vol kind of approach. And Tyler Neville was the one that came up with that framing, and I think it's accurate. I think that Bitcoin is a long volatility asset, and I think you want to be long volatility, but that doesn't mean that there's not going to be tremendous.
Right, you're going to get the volatility on the downside.
You get all that volatility.
Exactly right.
You're going to get it both. You're going to get it both ways. And I will kind of change the tune a little bit because this is fairly negative, right? But sort of like from a positive perspective is, given the transformation that's happening with the economy and like what AI is, I think there are going to be, generational companies that are going to be built in the next, 3 years. And the things that like Elon is doing with like SpaceX and all these other areas, right? I think the world is shifting, and these areas are going to consume a lot of capital, but they're going to change the world, right? And they're going to change it for billions of people. And the stuff that is going to happen in space and the stuff that's going to happen in, in efficiency and technology and everything else, right? Like it is going to change things. So I think that you can get a place where, like, as an investor, you can look at certain sectors where you might say, yes, it's overpriced, but those companies are going to grow, right? The same way that people thought about, buying Tesla, buying Palantir, right? Buying some of these companies, years ago, where you're going to look back and you're going to say, well, like today was a day where like some of these companies you could have bought that felt overpriced, but 10 years from now, they're going to be the future NVIDIAs.
Yeah.
From an investment perspective. And
for sure.
You can't get locked in like all of this bad news that's going to be happening, because these companies are going to keep getting bigger and bigger and bigger and bigger and more important. Just like the way that I thought about like Palantir when I bought it in low single digits, is that this was going to be an essential company for the future. So I don't think you can sleep on that fact that like everything is going to get destroyed. No, like there's going to be a lot of opportunities in certain sectors that were overpriced that traded down. And then there's going to be opportunities in things that we don't know, but the world is going to change, where those opportunities 10 years from now will seem obvious, but today they're questionable.
I totally agree. That's why I object to Doomer. It's like, no, man, if you have the right head for it, like there's going to be some generational opportunity over the next year or so.
And some of those great companies like that might actually experience a ton of volatility over the next year because of the world. Like you might get fantastic entry points. So like you want to know the spaces that you want to be in, the sectors that you want to be in, where do you anticipate growth, and have your wish list of companies.
Yeah.
And
that's my next task for myself, is to do exactly that.
You better drop that for the members only, Robert.
Yeah, no, they'll definitely get it.
You'll get a big bump that month.
Sectors, right? Like you want to know your sectors, you want to do it in like credit, you want to look at it in equity, because sometimes like the best place might be to do it and get exposure through credit products, right?
Yep. I'm thinking about, I think we're very aligned in that.
Question, not to open a whole can of worms, I know we're coming up in the hour, but like and this might have been it's like probably like rough to say it to a Bitcoin audience depending who you're talking to, but I remember when MSTR, there was all this talk about them getting to the S&P, and they were like, it's going to change everything about how companies are valued at. It's going to be about what assets are held on their balance sheet.
I didn't say that.
Going to be, I don't know who said, I can't remember exactly who said it. I can think of a couple. We won't drop names, but because I remember when that was happening, I was a little bit nervous because I was like, okay, so say we see a big downturn and you see stocks that are at a price point where you're just salivating at, but I was nervous because I was like, what if I buy now and it's at low prices, but then the way investing goes, no, it's not even that it goes lower. It's just like the way investing is, it won't be the same in 10, 20 years. Like you being able to buy Palantir a few years ago and then riding it all the way up from $3 or something. If it were to crash all the way back down, by the time 20 years from now comes, will the way we value companies change, and where my buying the huge dip on Palantir won't even pay off anymore? I was so nervous when that was happening. So I was like, okay, if MSTR comes in and changes everything about it, how am I supposed to even know what to invest in? That's when I was like, okay, maybe I just should buy Bitcoin.
Yeah.
And then I just kind of got cold feet. I wasn't sure what to think. So
Yeah, I mean that's a great question. I mean, I think that like I think they're two fundamentally different type of investments, right? So like what I'm talking about is companies that have real operating businesses that because of the sector and the space that they're in, they continue to make more and more revenue, primarily because of the importance of them as a company, right? So Palantir, right? They were getting government contracts because of the AI stuff that they were doing 10 years ago, and they kept getting more and more and more. And because they kept getting bigger, they became systemically more important. So the thesis was, we know they do a lot with the government from a defense perspective, right? 5 years ago, the government saying, look, we need to spend more. We need to spend more. And there were very few companies that basically had the agreements with the government that weren't already very legacy companies that were already working with the Defense Department. They were kind of like the newest company, but they were already implementing machine learning and AI. So this
I remember
basically saying like here, like we actually know what we're doing. We have pole position to this. So as long as we continue to basically build technology that we view and the government is actually telling us what to build and we can execute, we're going to keep winning those agreements and those contracts, and no one else is going to compete for them or be able to compete for them. There's going to be old legacy cyber companies that don't have a modern stack. And naturally, what ended up happening is that a lot of the people that were close to Palantir became very close to the administration. And now, it just became a very, very easy investment thesis from that perspective. Now, I sold it a while ago. I didn't catch the full ride. And the reason why I sold is because, again, I thought that they were overvalued. But I was wrong because it didn't matter that they were overvalued because they could keep getting more and more contracts. The government spends $560 billion, and Palantir positioned themselves at the inflection point that every government around the world needs Palantir.
Yeah.
So they became so important structurally around that. So that's an operating company that can keep growing and getting better and better. And the story actually keeps building and building. And then you say, yeah, it's overvalued, but it was overvalued 5 years ago. Yeah. And it's going to be overvalued 5 years from now. It's always going to be overvalued. But again, it's so structurally important that it doesn't really
they can keep growing. Interesting.
Right? Because they can keep growing and growing and growing. Whereas if you look at a company like Strategy, again, the reason why their balance sheet keeps growing is because they keep diluting you as a shareholder. They don't really have a operating business where the cash flow from their business is what's actually buying Bitcoin. So they're not getting better as an operating business. They've just gotten better at diluting you as a shareholder, which means the only thing that saves you as a shareholder is the fact that Bitcoin spikes.
Bitcoin goes up. Yeah.
And then you can actually catch up for that slack there. So I actually don't view that anywhere near the same thing. Playing that. It's an entirely different premise. And
the big gamble.
It's you're gambling on an asset price, whereas if you're investing in Palantir or some of these companies, like you're betting on a broader theme and trend of where you think the world is going and where does this company fit within the future world. And if you say that it becomes really, really important, those are the companies that become really good investments. And you can see that from Tesla and all of these companies where if you go back and even NVIDIA, right, and you say here, like NVIDIA at the time 10 years ago didn't seem like a good investment, but over time it became a better and better and better investment because of where the world was going. And there's plenty of charts out there that talk about like if you would have invested $10,000 in this company at this point in time, today it would be worth hundreds of thousands, if not dollars for it. But none of these investments that you'd have invested $10,000 at the time were obvious.
Yeah.
Foresight of like where you thought the world was going, and you could zoom out and you weren't shaken in your positioning, which is the same thing that happened for a lot of people that bought Bitcoin in the early days.
Yeah.
They invested in technology that they thought would change and could change the world, but it was the same investor that maybe bought NVIDIA, maybe bought some Bitcoin and decided to hold it for the long run. And I think Bitcoin is still proving its value to the world. There are more people that own it today than 15 years ago, but it's a technology that's continuing to evolve. And it may turn out that it continues to grow at a clip. So like we're all long Bitcoin because we have a longer view of where we think Bitcoin is going to be. But these short-term pullbacks are because of this volatility that's happening in the market, which is the same thing that happened to Palantir, that happened to NVIDIA, that happened to all these companies, including Apple and a lot of the great companies that today are, trillion-dollar companies. Like people forget Facebook today is Meta, right, is $600-700 stock. It sold off down to like $70.
Yeah.
And like
it's
over. Like no, nothing is over. Like these guys print money, right? Like all they had to do is like stop spending money in like the metaverse, get back to like business.
That's a really good example, actually.
And you can now like look at Facebook and be like maybe Zuckerberg wasn't wrong. Maybe he was just early. Like maybe
Yeah.
the metaverse does become a thing. Like 5
God, I
years
hope not.
now, right? Like it
Some
might.
capacity. I think some aspects it will. And remember, I got to get my hands on that list whenever you make that. You better let the Twitterverse know once that's out, because I'm getting my hands on that somehow.
Yeah.
Well, man, I'm also looking outside America too, trying to broaden
It's a good idea.
my
Gonna
view.
talk to some
If you
people. Where are you looking?
like I just I haven't done any real deep dive on any of this, but a couple charts that I've been watching. This is Brazil over
Oh.
SPX, and it's
Okay.
been obviously underperforming the S&P 500 going back all the way to 2008. But watching Brazil and commodity rich countries, I think that there might be something there. This is the IBEX. So the other thought that I just, again, very rough edges, very like initial thought, is the PIGS countries, right? So Portugal, Italy, Ireland, Greece, and Spain. They already dealt with all their leverage, right? They already dealt with their sovereign debt issues, 15 years ago almost. And so if you look at like the IBEX, which is Spain, if you look at the IBEX relative to say QQQ, I don't know. I think, look, generally it underperforms, but if you look at it on a logarithmic scale, we've kind of formed a bottom here. And like, if you look at the RSI, there's bullish divergence on the RSI. So, could the theme be something along the lines of the countries that already kind of dealt with their deleveraging event and kind of washed out, all the malinvestment?
How do you even get into these? How would you
I don't know. Just there's ETFs that you can.
Got it.
Yeah, I mean, there's ETFs. I mean, you can look at broader company exposure right into these markets. You can look at currencies. You can look at.
Currencies is like a whole other
Yeah.
There's going to be an immense amount of opportunities over the
Do you think
next
Robinhood
year.
will be the one to cater to everyone who does this, or do you think it'll be one app that comes out, or just be kind of all over the place?
I mean, I'm bullish Robinhood. Like I'm a Robinhood customer. I've been a Robinhood customer since 2018. I dealt with the whole 2021 thing, and I get why they were hated, but like my experience with them, they keep rolling out new features that are generally like the right idea, right? They had the cashback card thing where you could round up into stocks. Now
they have a $1.5 billion buyback. I think that just got announced today as well.
Yeah, and they got the banking Robinhood banking program that they're rolling out. They got the gold card, right? So like that kind of neobank stuff. But then you look at the trading, they're doing futures now. They finally have a brokerage that is not like super dumbed down UI, right?
Yeah.
They're doing futures that you can trade some futures. They're doing the event contract stuff. Like, and then crypto has been there a while, but like I like Robinhood. I mean, it's it's not TD Ameritrade if you're super sophisticated, but like as a company in general, I'm pretty bullish Robinhood. Yeah.
Very nice. Very nice.
Yeah. So you can get exposure to, all these different markets through a number of ways. I mean, I think that's the difference from like, top down versus bottoms up investing, right? Kind of saying, okay, well, like you're going to look at a broader theme, and you're going to try to define some type of like time horizon of like your investment, right? Is this like a 3, 5, or 10-year time horizon, and is it a broader theme? And then like what's your best way of playing that? Is it at the company level, corporate level, credit level, equity level, and then you'll sort of decide where you want to position yourself. Or you could just say, look, it doesn't really matter. I'm going to look at a company, and if I think this company is going to be, from a bottoms up perspective, say like this company is going to be important 10 years from now, I don't care if I'm early. Like I just think that this is going to change the world, and you make that bet, right? And
it's like Bitcoin, right? Like if you have a truly long-term time horizon and you understand the math behind the fiscal deficit and the debt and all that, it doesn't really like if Bitcoin is $10 million per Bitcoin in a decade or two, are you really gonna stress about, oh, I bought at 70 rather than 60? No, it's gonna be 10 million per Bitcoin. So having that really truly actual, I think that's a problem, is so many people might claim they have a long-term time horizon, but they don't actually.
They're using that money that they need.
Yeah, I mean that's
Yeah.
something I regret from my investing is that I wish when in my early 20s, right, I would have bought things and just spent 5 or 10 grand on them and just like those just like
Just
not
let them
look
sit.
for like
Yeah.
10, 15 years. I really wish I would have done that because I did have good picks, but I sold them early.
Yeah.
Mm.
All I needed to do was just not sell, right? And
My
just
dad
like,
always tells me about his one share of Facebook.
Yeah.
He's like way early. He's like, I had that one share of Facebook.
yeah, that one Facebook share. Again, I was there when they went public. I mean, like we got like
Right.
pre-IPO shares and the thing traded at like 28 and then traded all the way down to 16.
Bro.
And we loaded up for clients when it was 16 and
Wow.
But
Yeah, I was buying Eli Lilly in 2022. It's tripled. I was buying Palantir as well. I was very early and bullish on Palantir as well, Joseph. I remember. I remember it didn't feel like, now it seems obvious looking back. But at the time, it kind of was like a little strange, and you had to be a little kind of crazy
I was with
to
you there,
understand it.
Robert. I was early in Palantir as well, and I just I got panicked.
just-
I
I
panicked
mean, like
at
I bought
$20.
Dave at like $4, $5, and I bought it coming out of COVID, and I was like doesn't make any sense. They had the deal with FTX. They had 100 million, and that was the investment, and that didn't happen. And then it's kind of like, okay, this doesn't make sense. I don't really understand. I understood fintech really well, and I was like, here, like this is probably a good business, and I sold it. I got made multiple times of my money on it, and then like here it is at like 230, and then you're just like, really, like all I had to do was just like turn it off and be like, okay, is this company loved? Do consumers love the product? Do they use it? Are there millions of people? Are they fanatical about the company and the brand? If the answer is yes, why sell it? Because every time you sell it, it's an indication that you believe that there's a higher or a better investment in something else. And if you can't,
it's bearish.
Right?
By selling, you're kind of inherently bearish.
Exactly. You're
making a bet
against it. I found a better position. And if you say, look, I'm selling because I'm going to cash, then you're basically saying I like cash better than this company.
Yep.
Damn. Yeah. Wow. We're gonna have to do it. I think. Yeah. Once that's out for you, that'd be interesting to do a stream with you guys once that's out. And I'm sure Robert, you should put it behind a paywall. But I'm sure at some point you'll be talking about some of those picks in there. That'd be a good stream to talk about to sort of level up investors, because that's definitely. Like if we were to see a massive downturn in all markets, that'd be basically a generational opportunity that a lot of people don't ever get to see.
Yeah.
And if you're in markets like on the daily kind of thing, you're coming to the spaces and streams, like you're going to get such a ridiculous opportunity to get into. I mean, it's basically what they talk about. Like your grandpa's like, oh, dude, this thing happened 35 years ago, and you're like, dude, like I wasn't even born yet. I was on the playground.
Right. I mean, that was 2009, 2010, right? Like it was scary as hell. Every day the markets were down. Every day you're like, which company is like now is going to blow up? Which bank is not safe? But then you look at it and you're like, it was so scary, but that was the absolute best time because you could have bought anything and you were a genius. And you weren't a genius like 6 years from now. Like you were a genius within a year. And you were like a rock star if you kept those names for 10 years.
Hold them. Yeah.
And you would have bought like prefers that like, those prefers today, like again, a lot of them got called back, but like today they have like 50% IRRs on like bank prefers of like whatever was around because of like where you bought it. And again, a lot of them got called, but like there are names out there where like people are sitting on like really, really, really juicy dividends.
Yeah.
Because of where the names and the dividends kept like growing and growing and growing. And like these people didn't need to buy fixed income. Like these people could just like literally sit on buying some of these names at like $2. Today they're like $50 stocks. At $2, you had a 10% dividend yield. And like today, like the dividend alone is like $5 a year. And you bought the whole thing at 10 years. And it's paying like 2x your money of your investment every single year and growing in perpetuity. And you're like, that was the greatest generational wealth creation effect.
Those dividend paying ones could really, when STRC first came out and there's all this conversation around where can you put your money where it's relatively stable, but you can also get some payouts. I don't know if it'll be STRC or what it'll be, but I could I know for my generation, like that's a super attractive offer.
Between us, I don't think it's STRC.
Yeah. Yeah. A lot of people are nervous. I'm also nervous. I don't want to be in the first cohort of a tester, with like STRC. It could work. I think a lot of people are excited, but there are a lot of people like Robert and you said a little bit of, I don't know, just
apprehension.
Unease. Yeah.
Unease.
And that's it should be. I think it has to
I mean, look, like what I just described is an example of companies that their stock price had sold off. It had sold off for external factors. their business was impacted and the market assumed that they were going to zero.
Yeah.
And then the reality set in is that no, these were still companies that were important, that should be around, and they kept growing their revenue. And because they grew their revenue, they could pay you more money, and the dividend yield is big because of the success of the business. When you go out into the market and you offer a product at a certain rate, and you say, why are you paying a rate that's so high? To me, that's marketing. And you're trying to incentivize something that naturally that can't happen. And if Bitcoin goes up, you might be okay. But if Bitcoin doesn't go up, you're no longer okay. Like that level of like risk to the downside doesn't make any sense, because I'm taking debt-like risk, but I'm not getting paid equity-like risk for it. And to me, that makes no sense. Like if I'm going to take any equity risk, I want like unlimited upside.
Yep.
And this was the same thing that like I discussed with like the Terra Luna guys. And back in the day when those guys were doing it, I was like, guys, like you don't understand this instrument. You don't understand that like this works right now. But the moment it whips out, like the 20% you got paid, it was a blip. You were picking off an inefficiency in the market, but don't expect it to be lasting for a really long period of time, because it's not sustainable. There isn't anything natural or sustainable about that. And when you make investments that, you're buying things for like a dividend, like you want the company to grow, because if the company grows, your original basis stays the same, but your cash flow continues to grow on the basis of that dividend, because the company's actually doing really, really well over long periods of time. Like to me, that's structurally a good investment. And when you look back on it, you're like, this company's actually paying me a 30% dividend. No, like probably when you made the investment, it was probably paying you a 3% dividend.
Right, of course.
But because it's
They kept
grown,
cooking. Yeah.
you make more and more and more. And like, and this is like the story of like, the old ladies who like walk into like their brokerage firm back in the day, and they're making so much money and living from their income on their investments, but it's because they made those investments 30 years before, of course. And they got bigger and bigger and bigger, right? And I think this is the part that I think like that conservative investing in markets, I think gets lost on a lot of people, because they're like, look, I got to make money really, really quickly because of these gyrations around volatility. But you can make a $10,000 investment today in a good company that could be worth hundreds of thousands of dollars and maybe even millions of dollars over the course of your life. And if that thing has a dividend,
like an annuity.
Yeah, it's an annuity forever, right? Like you never have to sell it. You're never going to pay taxes on it. It's going to basically give you nice cash flow and distributions for a long, long period of time. And those opportunities are accelerated when you do get these sell-offs, and when you do get these corrections. You just have to have the courage to pick it up. And it's no different than like, people who have done really well in Bitcoin. They bought a bunch of Bitcoin in it. The only thing that Bitcoin doesn't pay you the dividend, right? But
exactly.
That's really the only difference. But it's the same fundamental premise that you can make good investments, and your best investments happen in times of stress. So the things that we were talking about, like we shouldn't fear them. We should say we got to be ready for them. If they happen, that's our generational wealth.
Yep.
Frame. But you can't do it in the eye of the storm. You got to have your rain jacket. You got to have your life jacket. You got to have your lifeboat, right? Like you got to be ready for it, right? Like, and you get ready for it by having your wish list. Right?
Smart, dude. This is a great conversation. We're gonna need to do a part 2 on this. This is fun. I don't know. I mean, I know it's like terrible to talk about recessions, but at the same time, like I feel like I've been in so many spaces and streams. I'm sort of numb to it all, which was the goal. I was like, I need to get numb as fast as possible so that does happen. I panicked for a few days, maybe with everyone else. And then I'm like, okay, I have not forgotten everything. I still understand these markets. Like we are good. Hopefully we're still doing streams and spaces with Robert so he can keep us calm as these things are happening. And we talk to Joseph on Tuesdays and still have a lid on what's going on. But dude, this is fun stuff, because I found I didn't realize, but like so many, even the Bitcoiners, a lot of them are hedged. They've got positions in the S&P and various stocks just to make sure that they're hedged. I just didn't know that like in the beginning when I was first doing those spaces. But the investor world is fascinating, honestly, and it's cool to like sort of research these companies and say like, hey, who's gonna holster, who's gonna sort of like uphold the economy for us? It's kind of like a fun game to play. Like I see why people get obsessed with this game. I see why Robert spends the 22 hours a day like on TradingView looking at these pairs and stuff like that. So No,
Yeah,
this is super
you can
fun.
go into like portfolio construction, right? Of thinking about
Yeah.
like how you manage your overall positions and your risk, right? Because like you can effectively be long these names, but you can still trade in and around them, right? Of these
Right.
periods of stress and add volatility and
Definitely
sell
true.
calls and and puts to be able to like add into your position and situations, and if not, basically that premium and generate current income, right? So like there's all these other things that you can do, which make the market really dynamic, and then you can look at your overall portfolio exposure and say what's the best way to basically put a hedge on it, right? Like we're all long Bitcoin, but there's other things that you can do to kind of like offset and buoy your portfolio that the markets might sell off, but you're not going to get hurt, right? Like you buy your insurance, and if you're really that concerned without kind of getting shaken out of your position.
Yeah, most definitely. Well, listen, look, I was going to say before we sign off here, for everyone who's watching the stream, thank you all so much for tuning in. Hopefully you guys learned something, enjoyed yourself. If you did, definitely be sure to follow Robert and Joseph. They're both tagged right above our faces. If you're watching on X, if you're watching on YouTube, go to the description. You can find them there. And a big shout out to Joseph and to Milo for sponsoring the show. As always, if you guys are looking to get into the Bitcoin mortgage game, if you guys are looking to take any loans of that sort, definitely check out that link down below in the tweet below the stream or in the description on YouTube. You can find it there. There's no rehypothecation or any silly business there. We've been working with Milo for a super long time. They do it right. And if there's anything there, it's going to be there. Shoot Joseph a message if you have any as well. But if you're looking to get into a home, you don't really want to sell spot Bitcoin, they've got options for you. So definitely recommend you guys check that out. Joseph, any final thoughts or last things you kind of want to leave with the audience before we sign off?
Yeah, I think we're going to probably be a little rocky here for a little bit, but I think that there's going to be opportunities. So I think you got to be ready for them, right? You got to do your homework. You got to put in the time. And
Absolutely.
if you do, then you'll get the reward out of it. Markets are amazing like that. It doesn't matter how good or how bad they are, right? Eventually they buoy out, and
yes,
you make money when you buy. Everyone always focus on the sell, but
yes.
you got to get the right entry points on things that you really like.
And I think it was actually, I don't know if it was Robert or someone. I think it was Robert. I mean, like we were even talking about gold a few months ago, and you were like, "Yeah, gold's one of those things they never give you another entry." And then here we are. A few months later, all assets are just up and down. Trump puts out the tweet, the entire S&P is down 1%. Like the markets are changing. You gotta stay nimble now.
I'm glad
I was fast.
I'm glad I was cautious on silver and gold.
Yeah, dude. Oh my God, I don't think anyone expected for those assets to come up and down the way they have. But Robert, any final thoughts before we sign off? This has been an excellent stream, dude.
No, diesel apparently in California just hit a record $7 per gallon.
Oh wow!
So
I'm sure people love that.
This is US diesel. Yeah, it's
Good
coming, guys.
Lord.
Like I understand people don't like it, but it's coming. Like something, it's just physics. So yeah, just strap in and do your homework and know what you own and know what you want to own, and that's my next project. Know what I want to own. So
the wish list.
Yeah,
Rob's wish list.
Yeah, most definitely, guys. Hit up Robert, find him on X, shoot him a DM, get him going on that thing, blow up his DMs, ask for the wish list. Follow him on YouTube as well. Subscribe to his YouTube channel as he continues to grow that out. He's doing a great job there. And guys, we'll see you guys all the next one. Hope you all have an amazing rest of your day. Take care.